Good afternoon or possibly good morning to wherever you're listening to us from today, but I welcome you all to the webinar today. The topic will be raising capital from self-directed IRAs and 401ks. We're going to dive a little bit deeper and look at kind of the other side from where we usually are on our webinars. We're focusing more on an individual who has an IRA or 401k and how they can invest it, to looking at it from the investment provider side and in different ways you can raise capital using IRAs and 401k funds for your particular investment deals that you have. For anyone who's listening live to the webinar today, please type any questions you have for me in the question box on your screen through GoToWebinar. I'll make sure to get those questions answered by the end of the webinar today. If you are listening to the recorded version of this webinar, you can certainly contact me. My name is Scott Maurer. I'm the Director of Business Development here at Advanta IRA. I've been with the company since 2006, and my contact information is here on this screen. During my time at Advanta, I've spent a lot of time working not only on the transaction side with different investment providers and processing the paperwork, but over the last several years focused more on building relationships with investment providers and people who are raising capital, and really showing them how IRAs and old 401k funds can be used as part of their capital raising strategy. So if you have any questions, again, during the webinar, please type those into the question box on your screen. If you're listening to the recorded version, please reach out to me, either my number here on this slide or at my email address as well. Just a quick background on Advanta IRA. We've been around for over 20 years, or almost 20 years now, and the only thing that we do at Advanta is administer self-directed retirement accounts where we hold alternative assets for our clients. So we have currently over $2 billion in assets under management. The slide here says over 9,000 active clients. We should pass 10,000 active clients here the first quarter of this year. At Advanta IRA, we do specialize really in two functions. One is the education that we provide, which today's webinar is part of that, educational outreach to potential not only clients but referral sources as well. But also more focused on the customer service side. And when it comes to capital raisers, I think this aspect is extremely important, that we provide every new client with a dedicated account manager, one person who will be their point of contact for anything they need regarding their accounts, whether it's just getting an account statement or it's processing through the transaction as well. Additionally, for individuals and companies that are raising capital, we try to also place all of your clients with the same one or two account managers as well, to give you a consistent point of contact as well, so that you are in tune with what's going on with your clients and your investors, and understanding our processes as well. Before we can jump into the meat of the presentation, to make sure everybody's on the same page, talking about really what is a self-directed retirement account. If you're somebody who is looking to raise capital and is new to self-directed retirement accounts, these are essentially accounts that give the IRA or maybe the 401k owner complete control over their retirement funds and what they choose to invest in. A lot of companies will claim to have a self-directed IRA, like a TD Ameritrade or an E-Trade may say it's a self-directed IRA because you can choose the stocks and the mutual funds you wish to purchase. But really, a truly self-directed IRA and a retirement account is one in which the owners of those accounts can invest in all of the potential assets that are available to them under IRS rules. They're typically assets that are invested outside of the stock market, and we'll get into what some of those investments look like here in just a little bit. With the stock market uncertainty, people are usually looking for other places to invest, and that's why they may be reaching out to you to see what you can provide to them with the different investments that your different investments that you're offering. It's important to know from your side, as a capital raiser, that people's IRAs, their old 401k accounts, can be used for these types of investments. In fact, the IRS rules only prohibit individuals from using their IRAs to invest in life insurance and collectibles like artworks, antiques, and things of that nature. So those are the only two prohibited investments. So as we go forward and talk about some of the different investment options today, just remember, it's only life insurance and collectibles that are prohibited under IRS rules. One of the things I think is important to understand is really the motivators or why people choose to self-direct. For a lot of clients, and I think certainly when you're talking about individuals raising capital, people who use their IRAs are individuals who maybe already are investing in those types of assets. So We have clients, for example, who like to invest in startup companies. It could be a new idea, a new concept they would like to invest in and be on the be on the early side of that particular investment. And for those individuals who those types of investments appeal to them, the IRA, their old 401k, is just providing them with additional capital they may need for another investment. So when they're presented with the opportunity of a new startup company to invest in, their IRA is simply providing that cash for that particular investment. They don't have to tap into their personal savings for those funds. Certainly, the other people who are choosing the self-direct, it's I mentioned already, the stock market fatigue, unsure of what's going on in the market, and feel more comfortable investing in maybe a startup company or a real estate syndication or something like that. Others, the benefits of self-directing and using their IRA to take on a new investment could be the tax benefits, in that the income that is derived from that particular investment or the profits on a sale return to the IRA either tax deferred or tax free. For individuals who are in a higher tax bracket now, when presented with an investment opportunity that has potential for significant gains, making that investment inside their IRA allows them to not have any tax realization now while they may be in those particular higher tax brackets. So these are some of the main reasons why people choose to self-direct, and certainly a couple people will tick multiple boxes here on the screen. It's really some of their underlying motivating factors. Get asked a lot of times though, why this strategy? Why, especially with new clients who come on board and start self-directing their account and investing in real estate and startup companies and gold and silver and the other different types of assets, why haven't I known about this sooner? And I think the most common reason is that most individuals who have IRAs, who have old 401k accounts, typically hold those funds in banks or with brokerage firms that are offering and limiting them to investing in only the products that they sell. They want you to buy the stocks, the mutual funds, CDs, things of that nature. They're not going to let you know that you have other options out there. Again, the IRS only prohibits you to invest in, you cannot invest in life insurance or collectibles. So there's certainly a lot of other alternatives out there that you have. But if, again, a brokerage firm does not want to let you know what else you could do with your money, in the fear that you would take that money and actually move it away from their firm and into those other investments. I liken it very simply to fast food options at lunchtime. You don't go to a fast food restaurant and they tell you that there are other options at the shop next door. It doesn't make sense. It's really the same principle that's involved with why brokerage firms and banks are not advertising to their clients that there are other options outside of what they offer. Getting to the capital source and why retirement funds, we went over a few slides ago the motivators for an individual who chooses to self-direct their IRA. But for someone who's looking to raise capital, why are retirement funds a good source for you? Why is this webinar that we're doing today important for you to know and understand and pass along to your investors? And I think the reason why retirement funds are a good capital source are certainly on this screen, and there's probably a little bit more beyond that as well. Certainly there's trillions of dollars, number one, in retirement plans as there is. I mean, there's over $37.5 trillion in retirement plans, IRAs and 401ks, and at best estimates, only about 4 to 5% of those funds are self-directed. So there's a lot of money out there, obviously, that you could use. Again, we touched on the stock market aspect of it. There are people who are looking for alternatives. When they look at their statement, they see what's going on in the stock market. They turn on the evening news. If things aren't good on Wall Street, people naturally look and see, hey, what else can I do? So naturally, you're going to have some people who are looking for alternative investments, especially if there's somebody that you already have somewhat of a relationship with, whether it's family, friends, acquaintances, business colleagues, etc. Having an investment alternative and showing them something that's different, that they can then get their IRA money out of those what they deem to be more risky stock market and into one of your alternatives. As I mentioned already, a lot of people look to, and some of the people that we have who are self-directing already invest in the same types of assets personally that they look to use their IRA funds. So from a capital raising perspective, you may already have a stable or a number of existing investors with on your platform, that when you then have a new investment opportunity, letting them know that they could use their IRA, they could use their old 401k to make that type of a similar investment they've already made with you could really be an easy way for you to solicit that additional funds. It's simply going to your existing database and your existing investors and showing them another way that they can take advantage of your opportunity. And then I think one of the other main kickers, and I've had this feedback come back, especially from some multifamily syndicators and real estate providers, that the reason why people like to use their IRAs for their particular deals is that those deals, especially when you talk about syndications and maybe those startup companies where you're locking up your money for a couple of years, more people are apt to want to use their IRA account for investments when they know that money is going to be locked in for 2, 3, 5, maybe even a 10-year period. Most people would prefer not to touch their savings account. You know, they might have a separate, their savings account and they have their retirement account. The savings account is for emergencies. It's a rainy day fund for loss of job, medical emergencies, etc. They, generally speaking, people don't touch their IRAs or their 401ks for those types of investments. They would go straight to their savings account first. So the fact that they're not planning on touching their IRA anyway for another 10, 15, 20 years, they don't mind locking that money up, you know, in a 5-year investment potentially. So I think for individuals, again, when you're talking to someone who has the ability to invest either with their savings account or with their IRA or 401k, they may be more apt to touch that IRA account because they weren't planning on accessing those funds anyhow. So a lot of the investments that we see, you know, certainly people raising capital for, in addition to the startup companies and some of the hedge funds, a lot of them are real estate assets, you know, rental homes, commercial properties, fixer-uppers, condos. But we'll talk more, have an example actually of a multifamily syndication and how that works, both from the investor who has the IRA, from their perspective, but also from the individual who's raising the capital as well. So we see a lot of different types of real estate assets within the self-directed IRA world. Now, the next few slides, I think, again, for someone who's looking to raise capital, you want to understand some of these terms, but you don't necessarily have to know all the nuts and bolts of the particular accounts that we're going to talk about and ways to move the funds. But as far as, you know, what accounts can be self-directed, it really helps as certainly someone who's raising capital. If you're talking to people, what money they would have access and be able to use. So the accounts that can be self-directed and used for investments into your projects, any type of IRA, traditional or rollover IRAs, Roth IRAs, you have SEP and simple IRAs, people who may be self-employed or own a small business may have a SEP or a simple IRA. So if you're talking with a potential investor who has an IRA account, they automatically can use those funds to invest with you. So again, if the designation on the account is an IRA, you can certainly self-direct it. We also offer for individuals who are sole proprietors or own their own business, the solo 401k, or sometimes called a QRP or a qualified retirement account. Those are good, well-suited accounts for people who own their own business. Most people don't have any employees. They're just working on their own. Those accounts can be self-directed. And certainly I think that the big bucket of money sometimes it goes missed, especially from the investor side. Some people will forget that they even have these funds or not even sure where they're at, are the former employer plans. People who've left a job and have left behind either a 401k, maybe a 403b plan, 457, or the TSP or the thrift savings plans for governmental employees, you know, old pension plan. Whenever someone has left their employer, whether it was voluntarily because they quit and found another job and moved on, whether they were laid off, even whether they retired, once it is a former employer plan, the individual has the ability to roll that money out into an IRA with any other custodian that they choose. So that, again, that's a bag of money. If you're talking to someone and said, hey, I'm raising capital, do you have an IRA? They may think, no, I don't have an IRA. All I have is that old 401k for my job I left 5 years ago. But those funds can certainly be used as well. The only accounts that there is some restriction on, maybe a lot of restriction on, are current employer plans. If you are talking with investors who their retirement dollars are tied up in a current employer's 401k or 403b type plan, those plans generally restrict anyone under the age of 59 and a half from moving money out of the plan while that individual is still employed. The individual can always call and ask and see what flexibility they may have. But generally speaking, those current employer plans for individuals under 59 and a half are restricted from being able to move that money. But again, any type of IRA, any type of former employer's plan can be used to make an investment, into one of your projects. And the question that you may get asked, again, you don't need to know the details of exactly how this process works, but how do they move money? So you have an investor who has an old 401k or maybe has an IRA account and wants to invest. Their concern in moving that money is to preserve the tax status. IRAs, 401ks are tax preferred investment vehicles where the gains are coming back into the account with no tax consequence. The contributions are made and there are tax benefits for doing that as well. So clients are very certainly and understandably concerned when they move money from one custodian to the other to make sure that they aren't taxed on the movement of the money, and also make sure that money is going into the correct place to avoid any future tax consequences. And moving money to a self-directed account occurs either via transfer, which is when you move money directly from one IRA to another IRA account, or a direct rollover when someone does have one of those former employer plans. When they do move that money from that old 401k to an IRA, it's simply considered a direct rollover. Again, so I think from the perspective of someone who's raising capital and somebody has an IRA or they have an old 401k, it's not important whether you're using the term transfer or direct rollover. It's simply letting that client know that it's going to be a non-taxable movement of money. As long as the money never touches the individual's hands, there's no tax consequence to the individual client themselves. So again, it just depends on whether the client has an existing IRA or whether it's an employer's plan to determine whether it is a transfer or a direct rollover. One thing to note, a lot of times with direct rollovers from old employer plans, that process can take 2 to 3 weeks, just depending on who that other custodian is, to get a direct rollover from an old 401k and into an IRA. It's typically just a matter of fact that they send checks when you contact an old 401k company and ask to roll that to an IRA. They typically will send a check and mail that to us. That just obviously takes longer to get here and then have that check clear. Transfers from IRAs can typically be done anywhere from a week or so to maybe 2 weeks, just depending on who that other custodian is. But again, important part to know, tax-free to move money from an existing IRA or an old 401k into a self-directed account. So some of the investment structures I think over the years we've seen, certainly again that people have been raising capital for, again, a lot of real estate type investments, whether it's a rehab project, whether it's multifamily, which is something that has really taken off in the last 4 to 5 years, at least certainly what we've seen on our end. Even people making unsecured notes or loans or even mortgage loans from their IRAs to another real estate investor. So again, a lot of the investment structures that we see, even again on this side of the equation, still have real estate as a core asset. Even some of the joint ventures can be individuals, one individual using their cash, another individual using their IRA to buy the same property on a joint venture type basis. But outside of the real estate realm, again, there are startup companies. There's private stock offerings, maybe from a private bank or local institution that's just looking to raise some additional capital, offering some of their stock. Certainly hedge funds, other types of private funds, business ventures as well. So again, these are outside of, a lot of times when we talk about our individual investor webinars, we're talking about buying a single family rental property or lending money to an individual. But looking at it from the capital raising side, these are some of the bigger buckets that we see. Again, especially the multifamily side has really been taken off over the last 4 to 5 years, especially. Again, in talking to your investors, I think it can be helpful to kind of get in their mind a little bit side what type of an investor are they? Are they somebody who's more active and wanting to be involved? Or I think for people who are raising capital, you probably prefer individuals who may be more passive. An active investor might be somebody who wants to invest more in an actual rental property, not necessarily a multifamily syndication or investing in somebody else's rental, but buying their own rental property where they're going to have more control. They're going to make some of the decisions. Again, if you're rehabbing a property through an IRA, you're making a lot of the decisions on what happens within that rehab. and being a little bit more hands-on. So active investors are going to be day-to-day people wanting to know what's going on and be actively engaged in that. Now, the downside of being an active investor is certainly there's a lot more time, energy, and expenses involved with being a landlord, with being a project, someone overseeing a project of a rental property or a rehab project, and certainly being responsible for all the details as well. What paint color are we going to use? Who am I going to hire to actually do some of this work when overseeing a particular project? Contrast that again with people who are passive. And again, I think that the passive people who are passive investors are who are investing in these capital projects. People who are investing in private placements, the syndications, doing the private lending, where there's not nearly the amount of time commitment. If you're buying a rental property on your own, you're doing your due diligence on the property, you're trying to figure out who your tenant's going to be, et cetera. People who are investing passively into one of your projects really are looking at you up front. They're looking at the project, and once they've made the decision to make the investment, they're kind of done from that side of the equation, other than waiting to receive whatever returns and income from your particular investment. They're not going to be bothered by the day-to-day minutia. That's what you're doing as the person raising capital. The downside, obviously, they're going to have a little or no control over the investment, which again, from your side as a capital raiser, is what you're looking for. Maybe you're looking for people who are a little bit more passive, who are going to be able to evaluate the deal up front, give you their funds, and then step back and just wait for the returns, and allow you to make the decisions as the investment sponsor themselves. So, a lot of you looking to raise capital might be much more on the active side, but I think the investors you might be seeking are people who are passive. It is people who have, 9-to-5 jobs where they're looking to make some investments on the side, but not really being bothered on a day-to-day aspect. So to go into some of the case studies here and go through a couple of the examples, again, trying to look at these investments from both the perspective of the IRA owner, the actual investor themselves, and also the individual who is raising capital. In this first case study, we're going to talk about someone who's looking at funding their rehab project by getting private financing from an outside party. In this particular case, we have Bill and Stephanie. Bill has bought a house to flip, but he needs someone else to come in with cash to help him fund the rehab of the house itself. So his acquisition of this property is strictly buy and flip, quick profit. He's known Stephanie for a number of years, and he explains to her, hey, you have an old 401k account. You could use that to invest in real estate, and here's what I'm working on right now, this particular project. Bill lets Stephanie know, hey, I need about $50,000. I'll do a private loan with you. We can negotiate and talk about the different terms that are involved, but those are the monies that we need in order to do, hopefully get the project completed and ultimately get the project then sold. So again, working out the loan terms, when you're doing a private loan from someone's IRA to you, or you're looking to borrow money, that those loan terms are going to be decided between the two of you. It's important from an IRA perspective that the investment paperwork, and this will carry on not only for this case study, but the ones we have going forward as well, that all the investment paperwork must show that the IRA account is properly titled and is the owner of that particular investment. So for this particular investment with Bill and Stephanie, the note that gets signed, the mortgage, if there is one, must show that her IRA account is the actual holder of that particular note. That's the lender in the particular deal. Again, that demonstrates to the IRS that this loan is coming from the IRA account. So when the funds leave Stephanie's IRA, that money is not taxable to her, and any future gains are going to flow back to her IRA account as well on a non-taxable basis to her. So that's one function that Advanta is going to serve in the process. If you're raising capital, whatever investment paperwork you use, whether it's a note in like this situation or whether it's private placement documents, we're going to want to make sure that the IRA gets reflected as the owner in that particular investment. We do ask that the documents be provided to us several days before the investment is to be funded, just so we want to make sure that this wording appears in the documents, and also want to make sure that in this case, Stephanie reviews and approves the paperwork as well. We don't have any requirements on who would draft the paperwork. Doesn't have to be an attorney, but just note that we cannot provide examples or draft the documents for you or for the IRA investor. All we can do is make sure the right wording is present on those documents. So in this particular example with Bill and Stephanie, she was lending him $50,000. They agreed that the loan would earn 5% interest, but that also when the project sold, that Stephanie's IRA should receive 25% of any profits above and beyond what the sales price was. So some of the money coming back on this investment to Bill, he's agreeing to share with Stephanie's IRA, and they secure that loan with a first mortgage on the property. They have Bill's attorney prepare the note and mortgage. Again, Stephanie needs to review those documents, review all the clauses to make sure that she approves of the investment. Advanta is going to look at it from the standpoint of making sure, again, the IRA is properly listed as the investor and as the lender in this particular deal. When this project is complete and 6 months later, she's going to sell the property. He's going to sell the property, say, for $200,000. That results in a $40,000 profit to him after closing. Stephanie's going to help provide the payoff amount to Bill and to the title company handling the sale of the property. So for her IRA, she gets back the $50,000 initial principal. There were 6 monthly payments in there of about $1,600, and she earned $10,000 for her cut of the profits on that particular investment. So she earned about $11,600 back into her IRA over a 6-month period, which is a pretty dang good return coming back into her IRA for providing that private loan. Now, that's again looking at it from the investor side of things, but from the capital raiser, in this case, Bill was the one looking for capital. By using the IRA account, he was able to still net a decent profit on his real estate deal and able to get that money from Stephanie's IRA in order to finish his project. From the IRA perspective, in this case, all Bill had to do was convince Stephanie that his project was worthwhile and agree on the loan terms. After that, it's a pretty straightforward process. Bill wasn't having to look to get a second mortgage on a property, grab cash from other places, or go to a bank. It was simply convincing Stephanie that this deal was worthwhile and was able to borrow the money specifically from her IRA account. So as we go into our next case, I'll just remind you, if you have any questions as you're going through the presentation live today, please just drop those into the question box on the screen. I'll make sure we get to those again by the end of the presentation. Now, as we go into our second case study, we'll talk about investing in multifamily. As I mentioned, this has been a huge upswing that we've seen over the last several years with people looking to invest in multifamily. In this case, we have Nicole and Bill. In this case, Bill is the investor. Nicole is the multifamily syndicator who's lined up her next apartment complex. So she's found another maybe mom and pop operation that she was able to take over, but she needs about $2 million in private funds in order to get to closing on the project. So she's looking to raise that again from whatever sources that are possible. She works with an attorney to set up that syndication investment and be able to take in investors in $50,000 increments. Bill met Nicole at a multifamily convention. He has money in his Roth IRA account for this particular project that he's willing to potentially use. So from Bill's perspective, again, he's going to open up his account, complete the documents to establish it, and request that the other custodian, in this case, transfer the $100,000 from his Roth there to the account with us. On our standpoint, Advanta will submit that paperwork to the other custodian, and we'll request the subscription paperwork from Nicole. So as the capital raiser, Nicole is going to need to provide us with whatever investment paperwork that her attorney has drafted. In the cases of syndications and other types of private placements, usually that is a subscription agreement. It can be anywhere from 3 to 5 pages, maybe even a little bit longer, depending on the attorney that drafted it. But again, the subscription paperwork is what's important to us as the IRA custodian, because we need to be able to document that Bill's Roth IRA account is going to be the investor in Nicole's particular syndication. So again, as the capital raiser, having that paperwork, getting that paperwork to us in advance. If Nicole was the one that had referred Bill to us, Nicole said, hey, here's my friend Bill, he wants to invest $100,000 with me. Here's the investment we're working on. Here's all the paperwork you're going to need. Again, it just makes it for a very smooth and easy process. It allows us as well to go through her documents, her subscription paperwork, make sure we understand how it's to be completed so that we can help Bill get those documents done as well. So again, for the investment process, our Bill's account manager is going to work with him and Nicole to get those documents completed in the name of the IRA and have Bill approve of it. Again, the subscriber's name needs to be the name of his IRA, Advanta IRA, for benefit of Bill Jones IRA account. And also importantly, using our tax ID number, not his social. So any future gains in income and any tax consequence from this particular syndication needs to be reported back to our tax ID number, not to Bill's social. Ultimately, Advanta does sign the subscription documents on behalf of the investor, and we wire money to the fund to complete that initial investment. Now, when Nicole starts sending quarterly dividends, she's closed on the property, got it rehabbed, she's getting income now from all of her tenants, sending some of that income back to the investors. That income must come back to Bill's IRA account. We can provide Nicole with the ACH instructions, or if those were asked for on the subscription documents, we're more than happy to provide that information to get the money coming back into Bill's IRA. Looking forward 3 years in the future, Nicole refinances the apartment complex, is able to pay back her investors with a little bit of extra kicker from the refinance and from the increase in value of the project itself. So he gets his original $100,000 back. He got the $8,000 a year for 3 years of the dividends, as well as the gain. Again, $44,000 total gain, about 15% annual return going back into his Roth IRA account. Did have a question come up before we jump into the next case study and another slide here in a second. What liability, if any, does a multifamily investor incur? Generally speaking, this definitely be something to make sure of if you're looking to invest in a multifamily project. Most multifamily investments and even a lot of private placements are set up that the investor themselves is a limited partner in the investment, whereby any actual liabilities that occur are going to go to any general partners. That any limited partners, their loss is limited only to the investments they made. So in this case, for Bill, if he invested $100,000 as a limited partner, his investment losses are going to be limited to that $100,000 that he invested and no more than that. That's typically most, again, not only the multifamily syndications, but a lot of private funds, whether they're set up as LLCs or partnerships, they're set up from the standpoint where the IRA owner, and really any investor, is a limited partner, which means you have limited liability when it comes to the actual investment itself, and you're limited only to what you've invested. But again, double check that if you're looking to invest in a multifamily syndication or other private partnership, or if you're also someone who's looking to put these together, you want to make sure that the documents are drafted in a way where your partners are limited for their liability. Now, before we go into the next case study, I wanted to touch on one aspect, especially when it comes to multifamily real estate. But it could really be for any leveraged investment. There is a tax that can apply to retirement accounts, and I guess IRAs specifically, when they are invested into leveraged investments. So again, multifamily properties typically are leveraged investments. If an IRA is used as an investment in a project that is leveraged, a portion of the returns that is relative to the percentage of the overall leverage can be subject to this unrelated business income tax. So for example, if the project is 70% leveraged, then 70% of the income that goes back to the IRA is subject to this unrelated business income tax. It's just kind of a little quirk of the tax rule, where if you are looking to leverage your IRA account, either because you're buying a rehab or a rental property yourself with financing, or in this case, if you're investing in a private partnership with underlying leverage, you have to be aware of at least the effects that UBIT tax can have on your returns. Just a note, kind of from our previous examples, interest income. So if you're just lending money from your IRA account, interest income, rents, dividends, generally speaking, are exempt from the unrelated business income tax or UBIT. But if you're investing in, like I said, a multifamily property, where the money coming back is relative, the income and returns are relative to that leverage, you're going to have this UBIT issue. Now, some people have used C corporations to help block how much effect the UBIT would have. The UBIT tax rate is typically around 37%. C corps pay a tax rate around 21%. So individuals have used C corps to help limit how much UBIT applies. But just note, if UBIT does apply to the investment, it's your IRA would have to file Form 990T, but your IRA can deduct a percentage of expenses. They can use cost segregation, other depreciation, plus there's an automatic $1,000 deduction you get every year. So for a lot of situations with multifamily in those first few years, the depreciation and other deductions end up where your IRA doesn't pay any UBIT at all, at least in those first year or two. But definitely something to consider when you're looking at these types of investments. Even with UBIT, you still may be getting a much better rate of return than other assets, and you're getting money into those particular hard assets like the multifamily. And just to get a couple of the notes on UBIT, losses can be carried forward. So if you do have a lot of losses in the first year, that means you don't owe any UBIT tax at all. You can carry those losses forward for later years when you may have a UBIT tax consideration. And also, solo 401ks, QRPs don't pay UBIT tax also. So for individuals who are self-employed, those accounts can limit how much UBIT they would have to pay. But I think, again, from the capital raiser perspective, you just maybe ask for people using their IRAs. They may be subject to UBIT on what they're investing in with you, and that's something where their tax advisor needs to get involved. At Advanta, we're not going to make the determination that UBIT applies. We're not going to file those tax returns, and we're going to point a client, again, to their CPA to help them determine what exposure they have and ultimately what tax consequence they may have from those particular filings. All right, getting back on track with our final case study, talking about investing in a private stock. Again, this could be a startup company. This could be an existing entity that is just looking to raise additional capital and by the issuance of some new stock from the company. So for our case study here, we have Larry has a rollover IRA from a previous job, looking to invest part of his balance, and he knows Mike, maybe through some business relationship, and Mike is part of a team. They're forming a new private insurance company, and in order to get capital into the insurance company, that insurance company is basically issuing their new stock to private investors. And because it's a private company, you would not be able to buy the stock in this insurance company through an E-Trade or through a TD Ameritrade. So that's a common thread with all these investments that we're talking about today, is that brokerage firms typically will not hold those types of assets. Whether it's a private loan, whether it's a multifamily syndication, in this case, even if it's stock, because of the fact that it is private, individuals cannot buy it through those custodians. As a kind of helpful hint as well to the capital raisers here on this call, I have seen people before, they'll have an investor who wants to use their IRA, and the investor says, well, let me check with my brokerage firm to see if this is something I can just do through my IRA there. And you provide them the subscription documents, they in turn provide that to a Fidelity or someone like that, and then they wait to get an answer back on whether that's something that can be held. And I can tell you 99 times out of 100, if not more, the individual cannot hold it on their platform. So that's, again, even though it might be private stock, those companies are not going to hold those types of private investments. Getting back to our case study, again, we're going to want Larry, in this case, to open up his account by filling out our paperwork. We're going to request a transfer from $100,000 from his other IRA account. Again, it's going to be up to Larry to do his due diligence. Again, with any investment, Advanta is not doing due diligence on the investments themselves. We are simply making sure that the investment paperwork in this case gets completed, showing Larry's IRA as a stockholder. And in this case, he's going to buy 100,000 shares at $1 per share. He reviews the offering documents. He reviews the stock subscription agreement as well. Our role at Advanta is going to be to make sure, obviously, the account gets open, make sure the funds come over properly from his other custodian. And we're going to want to make sure that the subscription documents for the stock, and ultimately the stock certificate that's issued, is going to be issued properly to Larry's IRA account. Ultimately, we'll wire the funds to purchase, and that stock certificate that your company issues is going to be sent back to us here at Advanta IRA for safekeeping. In this particular case study, again, this is based on something that we saw here at Advanta IRA. Larry held the stock with us indefinitely, but a few years later, that insurance company made the decision, filed all the right documentation to go public, basically, and go become a publicly traded company. And at that time, when the company went public, The shares were trading at $2 a share from the outset. So at that point, Larry had already doubled his money. Decides to go ahead and work with us to move these shares into a brokerage account where he's able to sell them on the open market, returning all of that money again tax-free back to his IRA account. So again, in this case, the two players were Larry looking for an investment opportunity outside of the stock market, meets Mike, and Mike is someone, hey, we need capital. We're trying to get this insurance company off the ground, get it in financially good position over a couple of years, then to go public, where the initial shareholders, people who were in at the ground level, end up getting handsomely rewarded for being part of those particular offerings. Before we kind of close up the webinar here, the last few slides that we're going to have and talk about what Advanta can do for you and what we can't do for you when it comes to raising capital. Had another question come up. It said, so it's a company that is a private commercial lending company. They have strong long-term demand. They've avoided dealing with SEC due to their lending partners acting as lenders, and lenders to the actual company, not company investors. What restrictions do we have when approaching people about using a self-directed IRA to loan money to us or our borrowers? I think I'm not sure exactly what restrictions you may or may not have. I think when you're looking to raise capital, you always want to make sure that you do have a good understanding of what's permitted under SEC regulations, so that you're not branded as an issuer or someone who is soliciting for selling basically a security. But I think any restrictions that you're currently operating in, if you're dealing with individuals as lenders, I think the same restrictions would be in place whether they're using their self-directed IRA account or whether they're using their personal cash. I don't think the analysis would be any different. So I hope that answers your questions. Again, I can't really speak to what exact restrictions you may have, but I think that's something that an attorney would be a good resource for, to make sure that, again, you're not going to be accused later on of selling an unregistered security, which can be a potential issue for people who are raising capital. That's a legal question, but again, if you already know what restrictions you have in place for approaching people, I think in that case, it's not really any different from the IRA side of things. Another question came up: what are the fees to open a self-directed IRA with Advanta? What are our management fees? It's a great question. So our fees that we charge, there's a $50 account opening fee. There's a $95 transaction fee when someone's making an investment. All the investments we're talking about today, there's a $95 fee to process the paperwork to make sure that it gets properly titled. And then on an ongoing basis, we have a flat $295 a year custodial and record keeping fee. That's our fee to hold the asset, receive the income back from the investment, and also report to the IRS each year the annual valuations of that particular account. So those are the fees that your clients would be looking at paying if you're looking to raise capital. Again, it doesn't matter if it's $50,000 or $500,000, the fees are roughly the same, because the work we're doing is the same regardless of the dollar amount involved. Next question says, as a potential borrower for self-directed IRA, should I have some sort of disclosure being a private lender, being a qualified buyer, net income? Again, that probably goes a little bit more into the legal side, where at Advanta we're not allowed to give legal opinions. Again, I think the disclosures, the things you want to do as a borrower or as a capital raiser, I don't think the analysis is going to be any different whether it's someone's IRA account or whether they're doing an investment with you personally. There's nothing about self-directed IRAs that's different in that regard. Now, a lot of people, when they talk about qualified buyers or accredited individuals, a lot of the, in the case of this private stock example we just did, or maybe even the multifamily syndication example, there can be investments set up where you have to have accredited investors. And that means your investor as an individual has to meet certain levels of financial either net worth or financial acumen and being able to make these investments. When we process those from an IRA side of things, it's the individual IRA owner who is completing the portions where they're deeming that they are an accredited or possibly a qualified buyer or a sophisticated investor. And then it's just their IRA account as the mechanism that they're using. So it's not the IRA account itself that is being deemed the qualified buyer or the accredited investor. It is still the individual IRA account owner. So I hope that answered the question. Again, I don't think there's much difference in analysis, in your analysis for qualifying your buyers, qualifying your investors, whether it's an IRA or whether it's them as an individual. So how can Advanta help? And I've already kind of gone over the fact that Advanta doesn't do due diligence on investments, so we can't vet your investment for a particular client, nor are we going to sell it for you or really endorse it. When an investor come to us and says they would like to use their IRA to make this investment, again, our role is to make sure that the paperwork gets properly completed in the name of their IRA, make sure that the client as well has approved it from their perspective. So even though we can't sell though, and we can't endorse particular investments, there are certainly ways we can help you educate not only your current investors, but any prospective investors as well about how they can use their IRAs and their 401ks. Now, one way that we've done this with certainly some capital raisers, and happy to do it with anyone on the call as well, we can do a private landing page or marketing flyers where we use your logo, some of your contact information. We include an About Us section for you, and we can create this private landing page that we host, or a flyer that can be used to email out to individuals, use an email blast, putting it on your website, even just printing it out and sharing it one-on-one. We can create a couple different versions of those for you as well if you have different projects or different types of investments. And I have an example on the next slide that'll show what those landing pages and that marketing flyer looks like. We also can do online webinars. We have done private events where you and your investors, you're focusing on what type of investment you have. We can talk about the IRA. You talk about your investment. We're going to make it clear that we cannot endorse your investment. We're not, by being on the webinar, we aren't endorsing it, but basically talking to your investors that if they're interested in what you were selling, here's a way they could use their IRAs, their 401ks to make that particular investment. That can be an event with just it could be anything from just a conference call with you and your investor, to doing an online, 1 hour webinar on some of the things that we talked about today. Lastly, we also offer an online event we call Pitch, Promote, and Prosper, where we usually get 30 to 40 people on nationwide. We do it every other Friday. It's free to attend, where you're allowed to basically say, hey, here's what I'm looking to raise capital for. Here's my investment. Here's what I'm looking for, and potentially meet other people who are looking for places to place their funds as well. So here's an example of the landing page and the marketing flyer. The landing page is on the left, again, where it's got places for individuals to engage with us and schedule a consultation, at which point we will let you know that one of your investors was on our site. And again, it has your information, has your logo as well. Then we can also do a flyer for you as well about the easy steps it is to invest with your particular firm. Again, we've had people use that flyer in email blast, handing it out to people, again, just to let them know of a different way your investor can use their retirement funds, different way they can use their funds to invest with you in a project. And again, our Pitch, Promote, and Prosper event every other Friday, noon to about 1:30 Eastern time. We host that at Advanta IRA. The link to register is at the bottom, so you can see when the next upcoming PPP event is. And then, like I said, in these events, we do allow you to openly come on and say what you're looking for. Hey, I'm looking for investors. This is my project, this is my investment level, this is what I pay as far as my returns. Or if you're looking to sell an investment, hey, I have a piece of real estate that I want to get rid of. I have a note that I'm looking to sell, etc. You can come on that event and share that. Everybody that attends usually gets at least 2 to 3 minutes to talk about what it is that they're looking to buy or sell, and connect with other individuals on that particular call. So that concludes our webinar today. I don't see any additional questions, but if anyone has any questions for me here before we wrap up, please get those typed in to the question box on your screen. And really, just to wrap up, we never profess that someone should only use their IRAs or the one best answer to anyone looking to raise capital, and that's where you just have to get all your funds from. It's more so just letting you know and letting your investors know about another way, another tool in the tool belt that you can use to raise capital. Again, a lot of people, as I mentioned at the very beginning, there's over $37 trillion in IRAs and 401ks that people need to invest that money somewhere. And their options are CDs and money markets that be paying a low rate of interest on return. They could invest in the stock market, where again, some people are uncomfortable with the ups and downs and not understanding what exactly is happening within that account. Or they could potentially use that money to invest with you. And again, it could be a friend, colleague, someone you've met, just known for a long time through an investing community. They can place their money with you. Whatever returns you get, that's where their IRA accounts basically that's how they can earn. So again, it's presenting people just another opportunity, another way that they could place their money with you. And again, for you, that's just going to open up more capital in the long run. So so again, if you are looking for more information, if you have any questions, some people say, how do we set up the landing page for marketing? Just email me after the presentation. My contact information is here on this slide. Let me know what you're looking for, and I'll let you know exactly kind of what we need in order to do a landing page for you and a marketing piece. So yeah, here's my contact information. Any questions you have. Again, the one thing we're not able to do, I'm not able to present your investment to our clients. So I just want to make sure that that's clear. But you are welcome to come on our PPP event, sell the investment yourself, or have us help create these landing pages and marketing pieces for you to go out and help find your investors. So thanks everyone again for attending today. I hope everybody got something out of it. If you need any other questions, please don't hesitate to reach out to me. I look forward to seeing you on our next event.